Hi, I'm Grant Mundell, investment specialist with Equity Trustees, with our latest market update. In January, equity markets rose strongly, with the ASX 200 slightly outperforming global markets. There were some notable events during the month which impacted on markets. Firstly, a Chinese startup, DeepSeek, which is a competitor to or competitive AI model to the likes of ChatGPT, announced that it could be produced at a fraction of the price. Hardware and chip producers suffered. Investors are debating whether the hundreds of billions being spent by large hyperscalers such as Meta and Microsoft are going to produce an economic return, or whether low-cost production will accelerate and widen investment in artificial intelligence. This is important because the IT sector carries a large weight in the US equity market and has been a key driver of gains for the US and global equities over the last couple of years, so the implications may be meaningful. In the US, the Federal Reserve kept rates unchanged at 4.25 to 4.5%, wanting to see further progress on inflation. Robust economic data, sticky inflation, a strong labour market, solid consumer demand, and the Trump-related tariffs have all seen inflation expectations lift. As at the 13th of February, the market's only now pricing one rate cut this year in the US, and some are even talking about a rate hike. While we don't think the Fed will raise rates, we do think that US bond yields could move up to around 5% or close enough too, which could cool the US economic environment and pressure equity valuations. Also in the US, President Trump wasted no time signing off on a range of executive orders. Towards the end of January, import tariffs were announced against major trading partners Canada, Mexico and China. Tariffs and a potential trade war is one of the largest risks in the market at present. Should a trade war escalate, that would weigh on global growth and increase inflation. However, it appears that tariffs are being used as a negotiating tactic to address US trade deficits and protect the US economy. We see President Trump announcing a range of pro-US policies and see opportunities in the reindustrialisation of the US through deregulation and enhanced productivity. Nevertheless, in the near term, we'd expect increased bouts of volatility given the uncertainty. At home in Australia, despite solid labour market data and a 4% unemployment rate, a softer inflation print saw investors pricing in a higher chance of a February rate cut by the RBA. We think it's a more finely balanced call. However, we do see a rate cut coming in the next few months, and this should support an improving economic backdrop in Australia. We've entered reporting season offshore and locally. Heading into the February reporting season here in Australia, earnings revisions have been more positive. Thus far, we have noticed some positive dividend surprises as well. While we may not own the highest yielders in the market, we're focused on owning companies that are growing their dividends. Recent Aussie dollar falls may help ASX-listed international industrials deliver positive surprises. However, ASX 200 price-to-earnings valuation levels remain pretty ritzy at 18 times forward earnings versus the long-term average of around 15 times, and this leaves little room for disappointment. Notably, the US reporting season has been quite solid thus far, and expectations are for strong earnings growth for the year ahead. However, it was interesting to note that the Magnificent Seven have probably not positively surprised to the same degree that they did last year. In terms of the outlook, overall global economic growth and corporate earnings look pretty reasonable for the year ahead, but we do think the interest rate cutting cycle is going to be fairly shallow. The ASX 200 dividend yield of around 3.4% is well below the historic average of around 4.4%, and equity valuations relative to bonds don't look that appealing. Coupled with increasing global trade uncertainty, this leaves us mildly cautious on equity markets and tactically underweight, and intensely focused on holding quality securities at reasonable valuations. We prefer defensive assets such as cash, listed credit and fixed income, which are often offering solid risk-adjusted returns and reasonable income. Corporate bonds in particular are benefiting from high rates, solid economic fundamentals and low default rates. In our view, a diversified and active approach bodes well in the current environment to protect capital, but also take advantage of opportunities when they present themselves.